Hey, welcome investors to the 40 Finance channel. We've obviously had some solid volatility here over the past 30 or 60 days. A lot of high growth names have leaked out from their all-time highs. And if you buy stocks in lots, so if you sort of dollar cost average maybe across time, you could have certain shares of stocks you like that you purchase maybe at all-time highs, and now you're kind of picking up shares now that the price is lower to kind of dollar cost average. Well, one strategy that's out there that you may want to take advantage of is called FIFO, which is first in, first out valuation method. So in practice, this particular stock market that's melting down heading into the end of the year is kind of a perfect opportunity to take advantage of this. And it basically gives you a chance to sell the shares that you purchase, let's just say at all-time highs, to collect the tax benefits of claiming those losses, yet still hold your position and possibly build that position up maybe 30 days or so later after you get past the wash rules. So for this video, I'm just going to share what I know about FIFO, how I'm using it today with a specific example, and hopefully it helps you make some decisions, particularly if you live in the United States and you're trying to balance that world of capital gains versus capital losses. This is the time of year to sort of do a health check on gains versus losses to give yourself some advantages if you don't want to pay taxes maybe on all of your capital gains. All right, real quick here on Investopedia, first in, first out, FIFO. First in, first out, commonly known as FIFO, asset management and valuation method in which assets produced or acquired first are sold, used, or disposed of first. Bottom line here, if you own 100 shares of a stock, and let's just say you bought in chunks of 10, and let's just use the example maybe of, how about Roku, which had a peak all-time high that I think was higher than where it sits now because it's kind of bled out a little bit. But with Roku, let's just say you bought 30 of your shares over $300, okay? Now that stock is trading about $225, something like that, and you've been dollar cost averaging along the way, so let's just pretend you have 50 plus shares that are below $240 or something like that. The bottom line here is you've got these shares you bought for $300. Roku has taken a haircut. We're in an uncertain market where we're not sure if these growth stocks are really going to touch back to that 300 mark. So in this case, you could sell the 30 or so shares you have of Roku that you paid $300 for, and you can claim the tax loss on those while also lowering your dollar cost average for the future. So you get the benefit of locking in some capital losses, which can be helpful if you have more capital gains that you're about to pay taxes on. And in the long term, if you believe in Roku, you've actually held on to shares that are at a much better price point than what you paid when you purchased them at all-time highs. Now, one important point here is you would not be able to buy into Roku again for 30 plus days for wash sale reasons. So you can't just sell the highs and buy back lows because everybody would do that all the time. You will have to wait 30 days or so before you can buy more Roku. But since we're in here at December, it could be a strategy to help some of you that are trying to balance that gains versus losses ship. All right, now as a personal example, this is what I'm balancing right now on realized gains and losses. I have gains of plus 10,000. I have losses of minus 8,000. So I have a spread here of plus 2649. If the year ends and I don't do anything, then I will pay a small tax on this plus 2649 that I have here. Now, given the year that I've had in terms of the stock market success, I do not want to pay a nickel on taxes. So my goal here is to balance this number down to zero by accepting some more realized losses if I can find situations where I purchase stock at a very high price relative to where it is today, and I believe that over the next plus 30 days, I could get back in if I wanted for a lower cost. And one good example of that I just executed yesterday, I believe, and that is Magnite. So I sold 50 shares of Magnite at $21.52. That's an average of about $43. This is a stock that sits below $20 today. Now, I actually owned 300 shares of Magnite, and I've been following it down, catching the falling knife, if you will. Now, for me, I like Magnite, and I believe in the future of this one, but I also know that it isn't going to hit $42 before the end of the year. That's almost for certain. So what I gained out of this transaction, $815 worth of taxable losses that I can use to try to balance this world a little bit better. And I also got $908 back into my brokerage account that I can use potentially to buy other securities. All right, so looking at Magnite from a higher level, I'm down to 250 shares. Stock trades at about $18. My average price is $26. This average price, I believe, used to be very close to $30, $29, something like that. Okay, so I am still down $2,000, but I'm no longer down $3,000, right? And you can see, luckily, that I did buy Magnite in lots. And I have more lots that I could potentially sell before the end of the year. So by my calculations, I've got about 50 more shares that I might use to balance off the negative. You see 5 at 38, 5 at 32, 15 at 32, and 25 at 26. So once we get past that, if we get rid of those shares, I'll still have 200, and now you see the cost basis will probably fall, roughly to 25 or 24 without me doing all the math. So it's been a loser, absolutely for sure. But I do think that ad tech is getting beaten up right now, and I think that Magnite is in good position for the future. It may just take a couple years, though, for this one to turn around. All right, yesterday before I sold, I took a screenshot of the holdings prior to that live look I just gave you. And you can see that I opened a position in mid-March, 25 shares at $46. The stock's at $16. It ain't going to 46 for sure in the environment that we're in. $42, same thing. So I sold these 50, I believe, 25, 35, 40, 50. I sold these 50 right here. And that gave me some money back and locked in these taxable losses. All right, now in my world, I didn't have to do anything crazy to take advantage of FIFO. It is actually the default accounting standard in Ally Invest accounts, as you can see here. And I went to a couple others just out of curiosity in case it helped you guys. And it looks like at least on Fidelity, you have FIFO as the default method. I also went to Robinhood. Robinhood uses first in, first out method, so no changes required there. And lastly, I went to TD Ameritrade, and they also have using FIFO as the default setting. So in these 3 or 4 examples here, there's really nothing you need to do from a tax planning purpose to take advantage of FIFO. The only thing you need to do as an individual is just make sure, like, hey, if I'm going to sell 30 out of the 100 shares that I own, you just want to go back to your tax lot history and make sure that the first 30 you purchased were more expensive generally than the most recent ones. Now in 2021, if you purchased a lot of growth stocks, I would say more than likely stuff you bought in the first half of the year is going to be more expensive than it's trading for today, just because we've seen such a big correction recently in those growth names. All right, guys, so that's just a few tips on using the FIFO method to try to balance out your gains and losses. You know, nobody wants to pay taxes. It is a part of the game. But with this year and having such a big meltdown here at the end of the year, it makes a lot of sense to go in and really stare at your holdings and be like, look, it looks like I have realized gains more than losses. I got some losers in my portfolio. Should I pick those things off onesie, twosie, try to balance gains versus losses? And in some cases, like for me with Magnite, maybe you with Roku or something like that, you're going to get in there and you're going to say, hey, I still like this stock. I don't like the price that I paid way back in March or February. That's okay, right? This is what FIFO allows you to do, is get rid of your expensive shares, bring your dollar cost averaging down, help you balance things out for taxes. Just remember that when you sell like that, you are going to trigger wash sale rules. So you can't just sell your expensive shares, put them right back into cheaper shares of the same stock. You're going to have to wait 30 days for that. But eventually you will be able to. And in the case of Magnite, with what I used there, I mean, I had some shares in the 40s. The stock's at 18. There's no way that stock's going back into the 40s over the next 30, 60, 90 days. So I may very well add more to it. But while we're in this downward momentum, I was glad to kind of lock in a loss that balances out my gains. All right, guys, hope you enjoyed this. Please give me a like and subscribe if you did. We'll see you on the next video.